Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy investment advisor Ross Clark will run down the action on the major equity markets, gold, and a chart that could indicate the likelihood of a downturn in the markets. Inside Track President Eric Hadik looks at how major market upheavals tend to happen in the 7th and 8th years of a decade and how that might affect your investments. We'll be looking at steps that have been done to make it easier to invest in the junior markets. We'll be chatting with Peter Brady, the Executive Director of the BC Securities Commission, Shayne, Nyquvest, the Vice President of Mackey Research, and Rory Godinho, a partner at the Miller Thompson Law Firm. Plus, after the show, we will have company showcase updates with Cascadero boss Bill McWilliam and American Manganese CEO and President Larry Reaugh. We'll talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Pleasure to be with you, Jim.
Today we're going to be talking about the Hindenburg, and it's not a Zeppelin of any kind. It has something to do with the stock markets. Am I correct?
It is exactly that. Actually, it's a series or a set of indicators that are looked at. Actually, it was devised back 3 or 4 decades ago, looking at discrepancies in the market. As you get well along in a bull market, you end up with fewer and fewer stocks participating in the move. And so the Hindenburg was designed to look for specific things. You needed to be, first of all, in a rising trend. You needed to have the number of new 52-week highs and 52-week lows on the upside. So what you're getting in this case, we have had more than 2.2%, which is the magic number here, of stocks making new 52-week highs and more than 2.2% making new 52-week lows on the same day. You also need the McClellan oscillator, which is a measurement of the internals, to be negative, and we want to see a series of signals within a short period. In this case, we had first signal happen back on May the 31st. Second signal happened this week. And with that becomes then a confirmation of the signal. And the probability then of a correction of 5% or more in the stock market becomes fairly high. So with the market the way it has just been grinding its way higher with less participation on each one of these moves, we can see there is some vulnerability here. And what we're going to use as a catalyst point is the 20-day moving average on the S&P, which was tested during the week here this week a couple of times. Closed off the week just above it. So I think if you see a little bit of follow-through on the downside in the next week, a week and a half, look for that to gain some momentum. Now, we haven't had a good correction in the market since back in the U.S. election. So it shouldn't be unusual to be looking for something around a 5% level. And if I look back on my presidential model, a 4.5% to 6.5% correction into the summer is the norm. So that's pretty much what we're going to look at. The strong sectors have been biotech, have been the healthcare and utilities, and those are the ones that on any correction that I think investors should be looking at for opportunities.
What about gold and silver?
Well, got some good buy signals this week. Back on Tuesday, we sent out reports to Bob's clients or his subscribers and to my clients recommending the long side of the gold and silver and the miners. The the U.S. dollar had rallied into the early part of the week, and we had a nice break in terms of the gold and the silver market. Gold got down into the low 1240s, and we had what we like to look for, one of these sequential nines. That was 9 consecutive days with closes below 4 days earlier. Those had been really helpful at identifying turns in the last 3 or 4 years. And we had that in both gold and silver on Tuesday. The miners have produced some very nice oversold readings. So we've got a good bounce here into the end of the week. We're looking for some more strength, but you want to make sure here that this market gains some momentum. We're pretty leery about what the upside potential is, so I would be keeping tight stops underneath. Looking at this still as part of an 8-year cycle low. If it's anything like the most correlated one, which is the 1985-1986 model, there could be one more big clean out before we're ready for the bull market on the upside. And I would suspect that that type of a break would be much more accentuated in the silver and in the mining stocks than it would be in the gold bullion.
And the Bob you were talking about was Bob Hoy. You can hear his latest musings on HowStreet.com. What else is happening on the markets right now that we should be taking a look at?
Well, the other one that has been significant, we talked about the stair-stepping down that was happening in the crude oil market for the last couple of months, and we finally reached our initial target this week. 42.20 had been the November low, and when we look at the half a dozen good recoveries out of bear markets in the last 25 years, they typically top out after 12 to 15 months. And so that's what we did this time around. The low from the first quarter of last year, we saw a nice rally into the last 2 or 3 months ago, and we've been eroding away. And what you see in every one of those examples is that the supporting low that you rallied from, and in our case, that was the 42.20 low back in November, that one ends up getting retested. And if it happens quickly, if it happens within like a 4 to 6 week stretch off the high, you can anticipate that that low will hold and you'll rally back towards the old high. In an example like we have this year, where it's been more of a distribution pattern and a slow erosion, the probability is that we will thrash around here maybe in the $40 to $43 range for maybe the better part of a few weeks, but then erode away again to the downside, because this pattern looks heavier than something that would have had just that sharp correction. So think towards the second half of the year for where the best bargains might show up as far as the oil market is concerned.
Ross, thank you so much for being on This Week in Money.
Always a pleasure, Jim. My
guest has been Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, president of InsideTrack.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim. Glad to be here.
People are concerned about how equities have just been booming over the last 6 months. Are they at a dangerous peak?
Well, I think that we're definitely in an overall time frame where I'm expecting an important top, a top that could hold for even 1 to 2 years. But the equity markets have not given many indications that that has taken hold yet. Few of the indexes have certainly stretched beyond what I was expecting. Although the one thing that I keep discussing, and it has been consistent for at least a couple decades, is that the Dow transports notoriously lead the tops and reversals lower. And you can go back to 1999-2000 when the transports topped in May of 99, and most of the other indices didn't top until January through March of 2000. Even more recently in late 2014 when the transports topped in November, December, and most of the other indices didn't top until May or June of 2015, then you saw a pretty significant sell-off. And here again, transports topped in early March, right in the ideal time frame when I thought we'd see an initial sell-off, March and April. We got that, and the markets have pretty much consolidated since then, with several of the indexes spiking to new highs in the last week or so. Not an unusual event in a trading range like this, but it's all kind of setting the stage for what I've been expecting in the third quarter of 2017. That's when I think you enter the most vulnerable period, and one of the longer-term cycles that's reinforcing that, and it's, I should emphasize that it's the synergy of so many different timing indicators, wave timing objectives, and cycles that are prompting me to focus so acutely on this upcoming period. But one of those longer-term cycles is the decennial, a 10-year cycle that is pretty well known and recognized, but it has to do with the market having very strong tendencies to do certain things during specific years within the decade. And back in November, December, I kind of elaborated on that a bit and traced it back 160 years to when many of your most significant sell-offs were in the 7 and 8 year of the decade. And again, for the most part, that's no new news to people that follow this type of pattern in the markets. But I was really honing it down to specific periods within that 1 to 2 year time frame. And when you look at those corrections that we've seen, some of them more than just a correction, the period that's been the most consistent and synergistically and kind of all-inclusive to the downside has been the period between July and October, in many cases stretching into November. So really incorporating the third quarter and going into the fourth quarter of the year. But even going back, like I said, I trace this back all the way to the what was known as the Panic of 1857. And there you saw rail stocks peak in July of that year, and then led to what was known as the Panic in September, carried over into early 1858. And you get that pattern recurring. And some of the more notable examples, you look at 1907, which was when we were going through the 2007-2008 collapse here, there were some comparisons to the early 1900s, and 1907 saw a similar sharp sell-off between July and October of that year, where the Dow lost, I believe it's about 30-35%. and 1937-38 is really, had it not been for the 29 to 32 crash, the 1937-38 crash would have been one of the worst of last century. Still was one of the worst, but just was kind of dwarfed in comparison to what had preceded it 7 to 8 years earlier. But again, it was that time frame, some of the most significant downside was seen in that same time frame. You even see it in more recently in 1977, 1987 was your August through October crash. 1997 was kind of a twin or a pair of July through October sell-offs. First in 1997, that was the Asian crisis, and then a year later, in 1998, July through October, was the Russian ruble crisis with a sharper sell-off in the markets. And then in 2007, we saw many of the indices peak in July of that year, although there was a secondary top in October. So you've got this July through October, July through November time frame that historically, during the 7-year, during these periods of significant corrections, is the most vulnerable period in there, and so we are approaching that time frame. So certainly it's on my radar, and there are some early signs of topping, but no significant sell signals yet.
Do we know why it follows that particular pattern, or it just does?
If we do, I'm not aware of it. I'm sure there could be certain speculation or explanation for it, and even that time frame of year. There's different arguments, which I guess even go into the whole sell in May and go away type of adage, that summer and late summer tend to be some when the market sees some of these sell-offs. And October has historically been so many of the crashes. It's also been some of the significant lows, so it depends on which way you look at it. But there have often been some sharp sell-offs. And you even look just a couple years ago, late August was the real, in 2015, was a sharp decline coming on the heels of the Chinese equity market debacle, where it lost about 30-40% in just a couple of months.
Yeah, I remember August 25th, Black Friday.
Yeah.
It's one of those things that sticks in your mind. So could we be setting up for a similar thing this year?
Well, I'm not sure about the magnitude of it, because I think that that once a decline gets underway, it's going to stretch into 2018. I don't have enough indicators lined up yet and cycles really pinpointing whether this initial swoon would be the a real sharp one, or whether it could just be the first warning shot across the bow. I'm not looking for quite the magnitude of some of those previous ones, but overall, over the next year or so, I think we're going to certainly see at least on the magnitude of what we saw a couple years ago, and potentially a higher percentage sell-off in a lot of the indexes.
We'll have more with Eric Hadik next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Inside Track President Eric Hadik. Eric, the U.S. dollar, it's been, I guess, sliding in certain directions over the past period. What do you see for it in the recent future?
Well, kind of like we were talking about 2 weeks ago, I really thought that, number one, I was looking for a multi-month bottom to take hold in the dollar in early June. June 5th to the 9th was the week and the time frame that I saw as the most likely for that, and there were multiple reasons for that, but one of the more intriguing to me was that if you looked at a dollar chart going back to March of 2015, which was really its first significant peak, and really when it entered more of a sideways trading range that has gone on now for over 2 years. But after that peak in March, you saw a 23-week sell-off that covered about 8.5 basis points to the downside, and then the dollar recovered all the way back to retest those March 2015 highs. And then in late 2015, early 2016, you saw a very similar decline that lasted almost the exact amount of time, went for 22 weeks, and was within, I think, about 0.5 basis point of matching the magnitude of the previous decline. So you had some very symmetrical wave equivalents there, two declines of similar duration, similar magnitude, and which is very commonplace in a congested market. That's one thing that kind of tells you you're not trending, you're in more of a trading range and range-bound market. But when the dollar peaked in beginning of January this year, and I was first looking for about a 6 to 9 week sell-off, but in the midst of that, it broke through some key support that kind of said, uh-oh, this is a little bit longer term of a correction, and it indicated could be a 3 to 6 month sell-off, and started looking at that 22 to 23 week time frame, and sure enough, early June was the 23rd week of its decline. So the dollar was basically giving 3 corrections in a row of almost identical duration, and again the magnitude came within about 0.5 basis point of the previous one, a little bit less of a drop this time, which also reflects a little bit of underlying strength or resilience. But you had a lot of other things coming into play in early June as well that just told me there's a strong argument for a multi-month bottom at this time, and what I was talking about then was the possibility that could lead to a rally all the way into early September of this year, and there's some other reasons for that. But one of the things that I was detailing in early June was the correlation that I had been observing between when the dollar saw its more anxiety-inducing sell-offs this year, so when it was not just a normal down day, but either it was breaking through 2 to 3 month and 3 to 6 month support levels, or it was accelerating to the downside, at least on a multi-day basis. And each of those signs of breakdown were when you saw the biggest moves up in Bitcoin and Ethereum, and so it was becoming obvious that those cryptocurrencies were really benefiting when a little bit of faith in the dollar would be compromised. And that's, again, very typical of markets, and it's something that I explain in one of the axioms that I probably quote more than anything, but it has to do with markets correlating to each other, but doing it during the more pronounced, the more extreme moves. That when you're just kind of range trading, each market tends to move on its own technicals, its own fundamentals, but then when you have a big move in whatever the lead market is, that's when you see all the others kind of set aside their normal influences and pay much closer attention to that correlation, or in this case, an inverse correlation. Bottom line is, if those cryptocurrencies were seeing such strength during the dollar's sharper sell-offs, would that translate to the opposite if the dollar starts to show some signs of resilience and starts to gain ground again? Would that take a little bit of the shine off of ones like Bitcoin and Ethereum? And the first phase of that certainly corroborated what I was suspecting. I detailed how June 5th, the 11th, was a recurring intramonth cycle in Bitcoin, and I thought that was the highest probability time for a peak, and that Bitcoin had numerous intramonth and month-to-month targets surrounding $3,000, and Ethereum had a related target up around $400. Both of them hit those targets in early June, right in that June 5th to 11th cycle high, and then both saw a pretty sharp initial sell-off, 20 to 30%, and now have kind of consolidated since then. There's a key level I'm watching in the dollar index that if the dollar can break above it, that's when I think you could see a second shoe drop in the cryptocurrencies, and that some of the favor starts to swing back in favor of the dollar, and only for a limited time, and markets like Bitcoin and Ethereum that have been through such a parabolic move certainly probably need some sideways action to build a higher base, a higher plateau to move higher in the future. But for now, this early June time frame was when I thought we could see a pretty significant top in the digital currencies and a bottom in the dollar. So we've seen early corroboration to that, but I still need to see more to be convinced that it's going to be a 2 to 3 month rally in the dollar.
How risky are these cyber currencies?
Well, that's, it depends on who you talk to, but I would say at this stage in the game, they still incur an enormous amount of risk, especially when you look at the number of cryptocurrencies that are out there, literally dozens and dozens of them. I kind of drew this parallel to your .com bubble in late 90s, and the thing was that that whole .com bubble was built on the mentality and the paradigm shift that, simply put, the internet was the wave of the future. And that conclusion was absolutely right. But so many of those markets, so many of those stocks they were built on little to nothing, companies with no earnings and no product coming to market that were going at such extreme valuation that it was a classic bubble in the making, and the bubble burst, but that still didn't change the mindset that things were shifting to the internet, shifting to web-based commerce and everything else, but that doesn't mean that particular stocks, particular markets within that industry aren't susceptible to major declines. Took the NASDAQ 100 13 or 14 years to regain the levels seen then. And the parallel or the lesson that I'm applying there is that I'm not arguing the fundamental argument and the paradigm shift that digital currency probably is the wave of the future, and that when we look back in 10 years from now, it'll probably be very clear that things like Bitcoin was the pioneer there. But that doesn't stop you from having one or more bubbles in the midst of that evolution, and so, you know, if indeed many of them are in a bubble and they do burst, that doesn't change the underlying movement towards cryptocurrency. It just tells you that investors and speculators got so out of control that and so ahead of themselves that the levels that were attained much sooner than they should have been, and that appears to be where we are in many of them now. So I certainly put them on the high risk end of investments. And you just look at intraday volatility in something like Bitcoin, where, you know, hundreds of dollars could be a normal day's range from high to low. That's a lot of volatility for most of your investors to be able to handle.
And certainly being first doesn't guarantee success. Just take a look at Kodak. They invented digital photography. Where's Kodak now?
Well, and that's the case in so many things throughout history. The pioneers are often the ones that ultimately get slaughtered in one way or another. They're, you know, it's certainly attributed to them that they blazed the trail, and they were the ones that really got the movement going. But like you said, often they're not the ones there to reap the greatest rewards when it comes time for that.
We're speaking with Eric Hadik. Eric, Iran says they could have deeper cuts in oil production for OPEC. They even claim that there's 106% compliance with their most recently announced cuts, which means other countries that weren't formally part of the organization are probably participating as well. What's that going to do to oil, which is in the $43 range?
You know, this is similar to when we were talking back in October, November, and Saudi Arabia had kind of prematurely announced pending cuts before the OPEC meeting. I believe it was in late November. And then Russia came out and also reaffirmed that. Of course, when you really got into the details and the numbers, you know, it was one of those what is it, big lies and statistics, or whatever that cliche is. But when you looked at the numbers, okay, in the case of Russia, one of the top producers in the world, they had waited, you know, the whole year in 2016 had increased and increased and increased production, finally hit levels that I think exceeded anything they had done before, or else it matched their previous peak. But, you know, they were getting up to the upper reaches of capacity and then wanted everyone to freeze. And at the time, you know, they were saying they weren't going to cut yet, but they were going to freeze at this level. And in many respects, you know, it's kind of like reversing course on an aircraft carrier. Just because you reverse the engines doesn't mean the thing turns around right then.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, president of InsideTrack.com, inside spelled INSIIDE. Coming up, Peter Brady, Shayne Nyquvest, and Rory Godinho next on This Week in Money.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Taron property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, Cascadero.com, or phone us at 604-924-5504.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're going to be talking about the issue of rights offerings and other measures taken to make investing on the junior markets easier. My first guest talking about this will be Peter Brady, Executive Director of the BC Securities Commission. We'll also hear from Shayne Nyquvest, the Vice President of Mackey Research, and Rory Godinho, a partner at the Miller Thompson Law Firm. First of all, Peter, welcome to This Week in Money.
It's a pleasure to be here.
Peter, is the BC Securities Commission working on reducing the regulatory burden for the junior markets?
Yes, absolutely. The British Columbia Securities Commission has a dual mandate, Jim, and we're here to protect investors, but equally important is our mandate to have a good environment where companies can raise money, and we have fair and efficient capital markets as well. So venture markets, Jim, are incredibly important to British Columbia. We're home to about 50% of the companies that are listed on the TSX Venture Exchange, about 50% of the companies on the Canadian Securities Exchange, and we're talking about 1,000 public companies that call BC home. And in fact, about 50% of the market cap of those exchanges is also based here in BC. And one of the things I'd like to talk about, and one of the big ways we've been working on reducing regulatory burden, is by leading a national project to streamline the rules for rights offerings. We brought those rules into force in December 2015, and by about a year later, 30 companies had raised about $250 million, most of them junior companies. And in comparison, for the 7 years before that, maybe 13 companies a year on average were doing rights offerings. And those new rules that we brought in have also reduced the time to do a rights offering from about 85 days down to 38 days. So it's been a big win-win-win. It's good for investors, good for dealers, and it's good for companies.
What other initiatives has the BC Securities Commission been working on?
Well, in addition to rights offerings, we've had a new capital raising rule called the existing security holder exemption. We've done another one called the investment dealer exemption that supports retail investor participation in the markets. We've got a live project right now in which we are consulting across Canada on options for reducing the regulatory burden on all public companies, including junior ones. That could be how to raise money more efficiently, how to reduce the ongoing disclosure requirements, eliminate duplication, more electronic delivery. And we're strongly encouraging people to send in comment letters on that. And I also want to mention we've done something recently where a lot of investors are holding defunct securities, and often sometimes these are junior companies, and things didn't work out. And they're still getting statements, and we've adopted rules to allow those securities to be sold to dealers. Clients can stop getting statements they don't want to receive and get a tax loss. So there's just a number of things that we've done over the years to help the junior markets. Lastly, I want to mention our 4-month hold period project. We heard that this was an issue from junior companies for capital raising, and so we've been looking into whether we can adjust that as well. So we always want to hear from people involved in the junior markets, the companies, the dealers, the investors. The people that are doing it know best what could change, what could be better, and so we really, we have a number of projects on the go, but we're always open to hearing about more ideas.
For the financing of junior companies, what's the difference between a rights offering and a private placement?
So for a private placement, that is a company raising money, and they're not using a prospectus, a comprehensive offering document that's filed with Securities Commission. The company will instead rely on something called a prospectus exemption. So it's limited to investors who qualify for one of those. And the classic example most people would have heard of is the accredited investor exemption. And when an investor buys a security from a company in a private placement, they've got a 4-month hold period. They can't sell it even if the company's listed for 4 months. And very frequently there's no disclosure document that goes with that transaction. And in some cases, they can be quite fast, depending on the exemption that they use. So the difference with a rights offering is that the company is granting all of its shareholders the right to acquire more securities of that company on a proportionate basis. One big difference with a rights offering is that the securities are free trading. There's no 4-month hold period. They can sell securities that they acquire from the company right away if they choose to. There are some disclosure documents with a rights offering, a notice, and a circular that investors receive.
What are the benefits of using rights offerings to finance junior companies?
So rights offerings tend to be quite attractive to investors for a couple of reasons. As I mentioned, the shares that you get under a rights offering are free trading, so that's always a benefit. More liquidity is better than less liquidity in almost all situations. And there's usually a significant discount with rights offerings as well. And another big feature of rights offerings is they're often considered to be the fairest kind of offering. So every existing investor in the company gets notice of it. They get the opportunity to continue to participate in that company, like maintain their ownership share. So the offering is made on a proportionate basis, and so if you want to maintain your position in that company, you can do that. Sometimes we do hear when companies raise money, they then do a subsequent financing, and somebody can actually get control of the company through that subsequent financing. So the good thing about a rights offering is if you put money in before, but you want to maintain your position in that company, it allows you to do that. And in fact, rights offerings have really taken off in some jurisdictions like Australia. They've become almost the main way of raising capital, and because of some of the good features that I've just mentioned. And we'd be thrilled if they took off to that extent in Canada as well.
Peter, thank you so much for being on This Week in Money.
Hey, it's my pleasure. Thank you for having me.
My guest has been Peter Brady, Executive Director of the BC Securities Commission. You can find them online at bcsc.bc.ca. And continuing on the issue of rights offerings, we have on the line Shayne Nyquvest. He's the Vice President of Mackey Research, and Rory Godinho, partner at the Miller Thompson Law Firm. First of all, we'll talk with Shayne. Shayne, when it comes to the investors, how do they benefit when it comes to rights offerings?
Yeah, well, rights offerings are, to start with, the concept is not new to the industry. Australia has been doing rights issues, and in fact, probably 80 to 82% of their total financings are all done via rights issues. The reason for that is they are the fairest way to treat all shareholders, whether it's in the event of a rollback or a merger or whatever it is, and the biggest change in rights issues is it used to be a full prospectus required. And the rationale of, who needs less information than an existing shareholder who probably knows more about the company than the broker who sold it to him is the rationale for the change. We applaud the BCSC and all those involved for getting this through. It's now a 5-page disclosure document, roughly, and it, outlines the use of proceeds, the terms of the issue, the dates. So it's probably 1/10 of the cost, and it's without a doubt the fairest way to treat all shareholders, which is undisputable in that respect. So I think the concept of trying to raise larger pools of capital in the day and age of, reduced independent brokerage firms, wealth management money, banks, concept of wealth management and people's inability to manage their own financing. This is a way to allow shareholders to participate on the same basis of insiders and anybody else, and whether they subscribe for their rights or not. If they don't subscribe, other people can oversubscribe. If there's a large portion of rights being issued to insiders who are not planning to subscribe, that allows you to go, if it's a semi-mature deal that is moving down the food chain and has some institutional appeal, you have the ability to, knowingly that there's enough blocks of stock that can bring in some larger orders and accommodate them. It's just useful in a variety of ways and methods. Name of the game at the end of the day is how do we make bigger ones out of little ones, and how do we raise enough capital to do that? Raising small blocks of private placements is old school. It doesn't advance the companies, and it's time constraining. The exempt purchaser rule is, constantly maligned and, misguided. EMDs who, have exempt purchasers sign here, whatever, is a bad system for exchange management and regulatory. This is very simple. It's shareholders of record as of a certain date have a right to participate. Doesn't matter whether they're exempt or not. They participate on the same level as everybody else. So the lawyer or the young lawyer who's now been articled isn't exempt, has the same chance to increase his net worth through wealth creation, not wealth management, is very well served by this exemption. Bottom line is, how do we raise bigger pools of capital to advance growth in venture companies, and how do we find the next 20% of the TSX 300? So this exemption is one of the best that I've seen to try and accomplish that. And, there's some other new things being worked on. There's an early warrant exercise program that's being brought in on a couple of fronts. It's another good way of expanding and increasing the amount of capital raised for various projects, whether they be mining, oil and gas, industrial, telecom. Doesn't matter, the concept is the same. Anyway, that is a pretty general overview.
Now over to Rory Godinho. Rory, on the legal side of things, how do rights offerings benefit investors, brokers, and the company?
Well, as Shayne has mentioned, I think the rights offerings are a facility which allow free trading shares to be issued to existing shareholders of the company. And so when you compare them to private placements, I think investors tend to prefer not having a hold period. And there's a bunch of different ways of getting to that. You can do special warrant offerings, short form offerings, prospectus offerings. The rights offering is probably now one of the simplest forms of those types of transactions because they've updated the form requirements for rights offerings so that it relies on continuous disclosure, and so the actual rights offering circular is a very short 10-page or so circular that just sets out the basic terms. So I think from that perspective, investors are interested, and especially it gives existing shareholders an opportunity to participate in a turnaround or in a situation where a company, where maybe they need to, or they want to have an opportunity with a lot of the turnarounds that are occurring now to participate in the sort of reorganization of companies. So we're seeing a few rights offerings that follow consolidations where traditionally, insider groups would have taken most of the placement or the new placement, and instead they're doing some rights offerings, which gives all the people an opportunity to participate. So I think that helps from the investor side. As far as the brokerage firms are concerned, they can act as standby guarantors. They can become soliciting dealers and help facilitate exercise. So I think that gives them an opportunity to backstop companies that they feel are going in the right direction. And so that's mainly I think, and for the companies, obviously, an opportunity to raise money in a relatively cost-effective manner.
Rory, thank you very much.
You're welcome.
We've been chatting with Shayne Nyquvest, Vice President of Mackey Research, and Rory Godinho, partner at the Miller Thompson Law Firm. And we'd also like to thank Peter Brady, Executive Director of the BC Securities Commission. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, Peter Brady, Shayne Nyquvest, Rory Godinho, and thank you for listening. Plus, stand by for company showcase updates with Cascadero boss Bill McWilliam and American Manganese CEO and President Larry Reaugh. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. We're speaking with Bill McWilliam. He's the chair and co-founder of Cascadero. Welcome back to the show, Bill. And what kind of an update do you have for us?
Thanks a lot. And we have today to talk about two projects and their potential impact on the valuation of our company in the short term, or 6 months, or maybe up to a year. Yesterday we published some assays on a property called Santa Rosa, of which we own 100% interest in. And these are difficult things to talk about in a news release because IROC doesn't permit talking about valuations or prices or things like that unless you've got a 43-101 style report or a PEA report that's signed by a credible geologist. Let's just do what we used to do about 30 years ago and do a back-of-the-envelope calculation and put a little bit of math on this. Firstly, this is an open pit showing, and it's a big system. It's 7 kilometers long, and it's got consistent gold values over those 7 kilometers. Now, there's blank spots, needless to say, and this is not going to be one pit. It's going to be a series of pits, and that are all going to have, say we use an equivalent gold value of 4 grams, just for simplicity. So 4 grams in with the base metals in there works out to about $400 rock. And your mining costs on open pitting is far less than an underground mine. And most of the companies, most of the junior companies, I should say, are working on former producers or have put drill holes into a property that has valuation, gold values, but they're deep. And they don't put out 2 drill holes because there may not be continuity there. But we've got continuity. The system is large. It's right on surface, and we definitely have the grade in the deposit. So what this means is your mining costs for an underground deposit of 4 grams is probably, you got to build a shaft, you need underground workings, significant infrastructure underground, and your mining costs are much, much higher than, probably higher than $150 a ton before they can make any money. In our situation, it's on surface, and the mining costs are going to be very low, probably in the neighborhood of $50 to $60 a ton. Your processing costs are about the same as an underground mine, but they got to get it to surface. And the metallurgy is unknown at this point. We can discount the $400 a ton for metallurgy. Say it's only going to recover 80% of the metal. And at $1,200 gold, you still have a $140 margin per ounce. So this is the zone, we think, and this is the back of the envelope calculation, is going to be about 30 million tons. So you multiply 30 million by 160, and you get a very big number. And odds are, and as the calculations that the old-timers used, if your gross value of the ore is twice what your operating costs are, the deposit is usually economic. And that's the case here. We're going to document this all properly and make sure that I'm saying something that is realistic. So we have the opportunity here to seriously impact the valuation of our company in the short term. The second item we're working on is a property behind the Taca Taca deposit. Now, Taca Taca was found a long time ago. It's a big copper, gold, molybdenum porphyry system. It's now owned by First Quantum. First Quantum is one of the smartest companies probably in the world in terms of developing and making big mines work. They're heading towards 1 million tons of copper in concentrate, which is it's going to put them in the world-class area for copper production. And right now they're finishing the development of Panama Cobre, which is a big deposit. I think it's going to produce 380,000 tons of copper in concentrate per year. Once they get that a little further along, they're going to develop. They've got 2 properties that they can develop. One is Haquiri in Peru, and the other is Taca Taca that they own 100% of. What they've done, they just made a very smart move, in my opinion, is that they told the government of Peru, which is the host of Haquiri, and the government of Argentina, which is the host of Taca Taca, that they intend to develop one of those 2 deposits, and the government that gives them the best economic metrics and permitting, and community issues are a big issue now. That's the property they're going to develop. Now we think that just in doing a little bit of research on the 2 properties and knowing a little bit about the communities in both areas, the Taca Taca has the upper hand here, and Salta is going to get the business. Salta just passed a mining law yesterday that included 23 of the provinces. Salta was one of them. That standardizes the legislation that the provinces can make. It's a national mining act, but the provinces look after the jurisdiction of it. So if that happens, it's going to create a lot of excitement in that area, the Taca Taca area. And we are the main claim holder to the west of Taca Taca. And that property is strategic in 2 senses. Firstly, Taca Taca is probably going to need part of our land or all of our land to develop the deposit because they've got a very small claim and they're going to be moving 2.6 billion tons of material from the open pit to the mill or to the waste dumps. And if they have a couple of choices, they can choose to purchase our land, or they can truck the waste and pipe the tailings across north up the Sierra mountain range, and then that'll be way more expensive because mining and getting the ore to the mill is like 48 or 9% of your operating costs. The second thing about what we have is that we've been doing geochemistry in the background. By the way, this property is not Taron. It's about 200 kilometers from Taron. Santa Rosa is about 250 kilometers from Taron, from Taka Taka. But we've been doing geochemistry in that area, looking and have done a structural mapping of the area, and we've come up with some gold samples in one particular structure, fault-controlled system, that's right on surface, and the grades are very good. I'm not prepared to give them out at this particular time, but again, it's going to be an open pit. It's an open pit target. The grades are high, very high for an open pit situation. We have to go in and do some drilling on the property, obviously. We're going to get a reverse drilling program going sometime in July, and to see if the mineralization goes to depth. If it goes to depth, it's going to be a significant addition to the company's valuation. So that's what we're doing. We're working in 3 really exciting areas. Taron, of course, which we've finished the drill program. We're waiting for the assays. We've had a couple of glitches on the program. Firstly, the drilling was delayed by weather and other issues, and the work at the lab was also complicated by a certain issue in terms of the assay style. So that is, we're going to be receiving those assays in starting on Friday, tomorrow, and we got over 1,000 samples coming from Taron. We think, based on our look at the drill core, it looks exactly the same as what we drilled in 2009. 7 drill holes we put into the property then, and the mineralization in these holes, mostly in these holes, looks exactly the same as what we got in 2009. So we're expecting it to have a grade unknown at this particular time, but the volume that we're looking for is probably there based on what we can see in the drill core. So we've got 3 projects coming up here, and they're all going to be finished within the next 6 weeks or so, and we'll have all of the samples in, and I think we're going to get a serious impact to the valuation of the company.
Bill, can you tell us exactly what Cascadero does?
We generate properties. We started out as a property generator in Argentina in 2003. We've been there for 14 years, and we collected a large land position, which we worked our way through. In 2014, we changed our business plan from a generative model to a development model because we had enough geochemistry. We've got a large geochemical database from all the work we've done in an area called the Puna. We know a lot about a lot of properties, and we decided just to start focusing on one property at a time and try and move other properties along the valuation chain and do a little bit of work with more geochemistry, and now we're into a full development mode of 3 properties. So that's what we do. We're now going to be hopefully a producer, or have a property that a producer will want to purchase from us in the near future.
Where can you find Cascadero traded?
Cascadero was listed in December 2004 on the Vancouver Venture Exchange. It trades under the ticker symbol of Charlie Charlie Delta, CCD. It's currently trading at about 11 cents. It's got a $160 million market capitalization. A $16 million capitalization, and we think it's undervalued at this particular time. We have a strong board. We've got a strong advisory board, and we've got a group of very faithful, loyal shareholders who've been with us for a long time and have sort of suffered through suffered through a lot of delays and running out of money sort of stuff, but we're still here. We're now financed, we're not capitalized properly yet, but that's going to happen here also fairly shortly. And we're going to be able to spend the required capital on the properties, what they need to prove that they are what we think.
Where can people find out more information about Cascadero?
Well, we have a website. It's Cascadero.com. You can get it through any internet portal, and it has information on the properties. It has information on the company, and it has a list of all of the news releases we've published for the last 10 years. So you can, if you want to do some serious research, there's enough information there. The database is not published. The Geochem database is not published. It's a intellectual property issue. If you want to start a business in Argentina, or a mining business or an exploration business in Argentina, there's no centralized source of data as there is in Canada, in Ontario, for example, in British Columbia. You can look up a government database and find out information that other workers did on an area that is not possible in Argentina. So the Geochem database is very valuable, and we're not prepared to disclose it publicly.
Bill, thanks for the update.
Okay.
We've been speaking with Cascadero Chair and co-founder Bill McWilliam on June 15th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm your host, Jim Goddard. We're chatting with Larry Reaugh. He's the CEO and president of American Manganese. Welcome back to the show, Larry.
Well, I would say that I'm happy to be here, but it's one of those days, Jim.
Well, we've had some recent activity on the markets and a private placement with American Manganese. What can you tell us about what's going on there?
Okay, well, the first thing is we closed on about close to $417,000 of the first tranche in the private placement. And what I'd like to point out is that the directors took about 40% of that placement, which is a very positive thing. It shows that the directors are definitely anticipating that American Manganese has a great future. But in the meantime, we've been putting out good news for several weeks now, and every time we put out good news, we get selling in the market. And if everybody remembers, I've been talking about short selling for a number of years now. And one of the things that they do is when good news comes out, they sell stock or short stock. They short stock into the market to make the good news look bad. Now, how you can make good news, like the fact that everything that we've announced on the project itself has been super positive, and the directors are standing behind the company. We've had invitations and presented at various high-level conferences around the world, and we have more coming. These are peer-reviewed, so, it's another endorsement for the company. It just doesn't make sense to the shareholders out there. It makes sense to me because I've been following these short-selling artists for a long time on what they're doing, but it doesn't make sense for the shareholders, and the shareholders get nervous. And I can't say as I blame them. Good news comes out, and then they scratch their head. The stock goes down a penny. Well, in all intents and purposes, Jim, the stock should have gone up a penny. You'd think that good news would take stock up. Isn't that the way it used to work? But it's not necessarily working that way right now. But in the long shot, everything has been very positive for the company. I think that the shareholders, it's a tough thing to ask them to just basically ignore the short term here, that everything that's came out has been positive. We've got good interest in the project. So there's absolutely no reason for a legitimate shareholder to be selling. So these mostly are not legitimate sales. Certainly some of the smaller shareholders might panic and sell, and that's the whole idea of the short trader is to get the people, the existing shareholders, to actually sell the stock. So I just thought that we'd do a very short podcast today and say, the company is progressing along a line that's been very positive. All our results have been very positive. We're one of the companies out there that are, that are recovering and up to 100% of all the metals in the cathode material. Other people are talking about, just the cathode material, the cobalt part of it. And that's the other thing. The cobalt price has been going up. Last I looked, it was $58,000 a ton. And so you'd think that the potential product from a recycler of cobalt would be stimulating to the market. And it's just it's semantics. It's all perception, and that's what this is all based on. I just want to assure them that there's nothing critically wrong within the company, and that basically we are progressing. We're raising the money. We're going for the patents, which we will get in November, and cause for concern, in my opinion, is based on the day-to-day activity in the market, and there's not a lot that I can do about that sort of action at this time. But as long as everything keeps coming out well for the company, I think the future looks great.
Larry, for our new listeners, can you maybe explain what American Manganese is all about?
American Manganese is a company that's in the critical metals field. It also has properties in gold and cobalt. But our major focus is on a technology that we developed back with the production of electrolytic manganese metals. We came up with a patented process that allows us to compete with the Chinese producers of these metals on a level playing field, or the same cost. And it was recognized, certainly in the spring of 2016, that our process would work on the recycling of lithium-ion batteries. And we talked about EV batteries, but any kind of lithium-ion battery, and all the various chemistries that are in those batteries. And that concept went through proof of concept last year, and it's still going through for all the other chemistries at this point. We're getting them all back. So our focus has been on the recycling. Instead of producing ore from ore bodies, we'll be producing metals from batteries, and that's the whole upshot of it all.
Larry, where is American Manganese traded?
It's traded on the TSX Venture Exchange under the symbol AMY, and on the U.S. Exchange under the symbol AMYZF, and on the Frankfurt Exchange under the symbol 2AM. You can get data and do due diligence from our website, which is AmericanManganeseInc.com, or you can contact myself at LREAUGH@AMYMN.com, or give me a phone call at 778-574-4444.
My guest has been Larry Reaugh, CEO and President of American Manganese. We were talking on June 23rd. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.